Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Happy Monday morning, y'all. This is going to be a live video. Good morning to all of you. So today's going to be really special live video. Really try to put together a really valuable piece of video today. Try to feed you guys a meal of value and education. And really what we're going to do today, guys, I'm going to be as quick as possible. I want people to come back to my live videos and reference the information because I really feel like my live videos, I'm putting a tremendous amount of value here. But what we'll do is we'll start by going over what's going on in the market right now. We'll take a look at interest rates, the 10-year. We'll take a look at the Fed Watch tool. We're also going to take a look at a video of basically just some interesting stuff. I think you guys are going to find it interesting on what people are saying is going to happen as far as the Federal Reserve and increasing interest rates. Now, after that, you guys, this is actually the next two segments are so important. Okay, so the second segment is going to be, we're going to go over the top 5 crashing metro areas, okay? And basically, we're going to do a status check, okay? We're going to do a status check on the top 5 crashing metro areas to see how they're doing during the spring buying season. Now, I think it's especially important to pay attention to that part of the video because I've been getting some comments where, people are saying, Travis, we love you, or comments with Travis, we hate you. So it's either Travis, love you, or you hate you. But that the housing market crash has been canceled, that I just have to accept that the housing market crash is not happening. So when I hear things like that, I just think it's so crazy, you guys, because we're still in quantitative tightening. We still haven't even gone through a full cycle, and it's not the end of the year yet. So we'll look at year-over-year price decline. All right, a lot of people want to see year-over-year, so we'll look at all of that type of stuff. I think you guys are going to find it very revealing. So we're going to take a step away from the emotions, away from all the talking heads except me. I get it, and we're going to look exactly at the data. Now, after that, also really important, as we're kind of going into 2024, 2025, hopefully, the buying is a lot better then. I want to start equipping you guys with tools and with value. So the end of this video, I'm going to basically show you guys how to find a great deal. And I'm going to do that in as fast a time as possible. Now, here's what I did for you guys. Basically, we're going to fill this out. Okay, so I made this form, how to find a great deal. So we're going to go over data as far as price and rent for 2022 and 2021. We're going to find a property and we're going to calculate a payment together. So again, I'm going to try to do that in under 20 minutes. So, I keep doing that so that I can show you guys it doesn't take a lot of effort and it doesn't take a lot of time to use the data versus our emotions to find a great deal. In fact, the hardest part usually about purchasing a primary residence is controlling our emotions as buyers. And I've been doing this, you guys, just in case you guys don't remember, I've been in real estate for a couple decades. And if you guys can't do me a favor, like this video. So we're going to get started. Let me say good morning to everyone real quick. Todd, I cannot pronounce that. Tim, I'm not even going to try, brother. Good morning, Todd. Earl, good morning. Appreciate you. Appreciate you. Kim, it's always nice to see you. Bradley, I definitely appreciate it. I got that. I am blessed. So, and another thing, you guys, what I'm going to do is when I do this, like how to find a great deal, I'm going to take some random subdivision that you guys give me. So I am blessed gave me a subdivision to look at to try to find a great deal in Sienna Plantation. So that's what I'll be trying to use. You guys stick around for that. It's going to be really cool. Sacred, really appreciate your support. Good morning, sir. Good morning, Michael. I'm a day. TNT in the house. Florida beach bum. I wish I could be a beach bum. I got too many kids to be a beach bum. Good morning, Anonymous. Good morning, Eric. My man Johnny's in the house. You guys don't be alarmed, okay? Johnny's in the house. Everyone chill, okay? It's okay. But Johnny is in the house. Love you, Johnny. Hope all is well. Lala, appreciate you. Todd, everyone, definitely appreciate all you guys. So we're going to get started here. Oh, you're in spring. Okay, so you should like this summer because we're going to go over Houston information and some subdivisions here. But let's start. Oh my gosh, I've been watching the 10-year. Let's start, you guys, by taking a look at how do I want to set this up? I'm going to do it like this. All right, so I didn't really want to show this I'll be using to obviously go into finding a great deal, but let's do a market update real quick. I'm going to put the timestamp for our market update going now, but take a look at this, guys. Here's the 10-year. Obviously, we keep our eyes on the 10-year because the 10-year tracks what's going to happen really with 30-year fixed rate mortgages or residential mortgage rates. So that really applies to you and I that are potentially purchasing houses. Now, the interesting thing is, this has been going up and down. Good morning, Nikki. I see you, girl. This has been going up and down pretty much all morning. It started out with the 10-year, I think, down roughly it was either 3 or 4 basis points, but it's actually rebounded. It's down only 1 basis point. So it's going to be interesting to see what happens here throughout the day. You guys can see it's actually, so it's losing the downward trajectory that it started out with this morning. Take a look at mortgage rates. We already looked at this in our last live. This is not updated yet. You can see down here, last time it's updated was the 23rd on Friday. It ended interest rates at about 6.92. More than likely, y'all, I believe it's probably going to go down once this updates today, probably into the 6.8s, probably mid to lower 6.8s would be my guesstimate is what's going to happen later today. Now, take a look at this, y'all. This is very interesting as well. I like to kind of just stay on top of this. This is a CME Fed Watch tool here. So this is what the market is saying the Fed is going to do next as far as I'm a day. Good morning. See y'all. I see you guys. But as far as is the Federal Reserve going to increase the federal funds rate or the discount rate, okay? Which again, that's not directly per se associated with mortgage rates, although we can definitely argue that it has a bearing on them, but it's not tracking them. But anyways, guys, take a look at this. This is July 26th. The market's still anticipating a rate hike July 26th, about 72% chance there's going to be a 1/4 point rate hike. I also wanted to point out, now remember this, you guys. Oh, he's from Africa. Todd, I see you, brother. Remember this, guys. The Federal Reserve basically said during their analysis and meeting in the report that there's going to be 2 additional rate hikes this year. They said 2 additional rate hikes. Basically, they are skipping the June rate hike. Okay, so what's interesting is the market's not pricing in the second rate hike. They're only pricing in 1 rate hike, as you can see here in July. They are not pricing in a rate hike for September. You guys see that right here. They're basically saying a pause in September and only a 10% likelihood of a rate hike in September, but that likelihood goes up some reason in November from 10% to 16%. So the market is essentially saying, first of all, they don't think there's going to be a second rate hike, but if there is a second rate hike, the market is gambling it's going to be in November. Isn't that intriguing to y'all? Right before the holiday season. So that's very, very interesting. And if we go to December right here, 12% chance. So the crazy thing is, again, the market is anticipating a higher chance of a rate hike at the end, a second rate hike at the end of the year than it is in September. I thought that was very, very intriguing. I don't know if you guys agree with me on the intriguingness of that, but more than likely, we're going to have some more rate hikes, y'all. Jerome Powell has been saying that. In fact, the market seemed to have been blindsided about that. And not only that, Jerome Powell is basically saying we're not going to have any rate cuts this year. And the market essentially is pricing in the start of interest rate cuts. I believe it's May or March of 2024. So the unaffordability is going to be here a lot longer. And obviously, you guys, now that when the unaffordability stays here, it's going to create additional pressure on prices to continue to go down. And we'll be out of the spring and summer buying season here shortly. Kids will go back to school and the seasonality will come into play just like it did last year. And I just want to make a point. Last year, I was getting a lot more hate. I was getting a lot more hate this time of year. I started doing these videos around March of last year. And, remember last year, I didn't have any of this data and we had less inventory. We had more demand. Interest rates were lower. And what happened, you guys? Prices still went down and all that hate. So remember that. So right now, it's, again, from the data I'm looking at, it seems just as likely. And not only does it seem just as likely that prices are going to go down when we go into the other side of the pendulum swing, but I believe it's going to go down even more to the point where it actually a lot of things could break. The Federal Reserve obviously is overheating the economy, you guys, and the market. So what I want to do now is let me pull up this video here for you guys. I think this is going to be good for you guys to hear. This is kind of just someone else. Let me see if I can I couldn't even put this in full screen, unfortunately. Let me throw this up on here and let's listen to this. I think, again, you guys will like it. I just want to put a timestamp. So this man is basically going to go into, the fact that rates will stay elevated. We're going to hear things like the market is definitely fighting the Fed. This man doesn't think that there's going to be a recession. And he's also anticipating potential black swans coming in the next couple months. So really, really interesting. Again, pretty bullish on things, not so bearish, not so cautious, but I think it's very interesting to hear the perspective. So let's listen, guys. And if you can, this is about 6 minutes. So again, pay attention to this. Let me know that the audio is good if you can. I don't know why I cannot put this in full screen. It is what it is. But
now for a closer look at the market, the Fed, and so much more. David Rubenstein, Carlyle Group's co-founder and co-chairman. David, it's great to see you as always. I think I'm going to get a chance to see you in Aspen at the Aspen Institute next week. But let's talk about where the markets are right now, and specifically sort of where you think the Fed really is.
I think the Fed made it clear to everybody that interest rates are not going down this year. I think the market futures had anticipated a decline, perhaps by the end of this year, in interest rates or beginning of it. And Jay Powell's statement in front of Congress this week made it clear that at least for the end of the year, till the end of the year, you're not going to see any rate decreases. So the markets are adjusting to that. I think the market got ahead of the Fed, I think, a little bit. The market was anticipating some rate cuts, and I think Jay Powell made it clear that's not going to happen this year.
Are you in the camp, David? I don't know what the Carlyle House view is, but when you guys sit around on Monday mornings and talk about where rates will be, 6 months out, 12 months out, is your view that there's only 2 more rate increases? Do you think there's more to go? We've talked to folks on both sides of that debate.
The conventional wisdom today is you're probably going to have 2 quarter-point increases between now and the end of the year. That's the conventional wisdom, and we're probably with the conventional wisdom. But that assumes there's no big problem in China, no big problem, again, in the Ukraine-Russia war, no exogenous things we can't anticipate. But that's what the conventional wisdom is. But as some people have always said, the conventional wisdom in Washington is almost always wrong. But that's the conventional wisdom.
But so if you say it's always wrong, and I know you're saying this is your conventional wisdom too, do you have a view? Do you say to yourself, I'm going to lean one way, more one way than the other?
Well, you have to go with what the conventional wisdom is at this point, because we don't know what exogenous events could occur. But based on everything we know today, assuming nothing terrible happens overseas and no big calamities, if the Fed has made it clear they're going to increase interest rates about 2 more times, probably 25 basis points apiece. And then next year, they'll look at beginning a decrease, but no guarantees there either.
Do you say to yourself, as somebody who invests in the private markets and a lot of credit markets these days, do you say to yourself, I want to be buying now at these rates because they're only going to go up from here? I mean, this goes again to trying to decide where you think things are really headed. Right. Or do you say, I got to harvest now and sell?
The greatest fortunes are made by professional investors when things are troublesome. Right now, there is a lot of complications in the market. Some people are very worried about the real estate market, the real estate debt market. There's some challenges there, and we haven't seen them all come to the fore yet. We'll see some more in the next couple of months. So, yes, it's a good time to invest, assuming you're prepared to hold on. If you want a quick flip, that's probably not a great thing to do right now. But if you're in the business we are, which is making long-term investments, now is probably a pretty good time to invest because there's not as much competition. It's harder to get deals done. If you go through and work the deal through and you get it done, you get it financed, you're probably going to do okay in 4 or 5 years. Markets show that when private equity firms are looked at, what are the best funds, what are the best vintages, almost always it's at times when there's economic trouble. And so right now there's some trouble. Go ahead.
Given what you're seeing, though, among your portfolio companies, and this goes maybe to, it's almost like a Barry Sternlicht question. We just had him on earlier this week. He thinks things have slowed down way more than the Fed believes they have, and that his data is much more up to date, if you will, than what he thinks of as the lagging data that the Fed gets. What does the Carlyle data show you?
We have data on several hundred companies we own, and we look at that and we compare it to how the economy usually does. And we actually sometimes send that to the Fed as a way for them to have additional information. Our data does not show a recession anytime soon. This is the most anticipated recession in history, but it hasn't happened yet. And our data does not show a recession coming in the United States in the near future. Now, of course, things could change. But right now, our data is reasonably okay. We don't see decline in consumer sales. We see enormous spending in things like concerts and hotels and restaurants, things like that. So we just don't see it right now in the data.
What looks cheap to you right now? Where you say, okay, maybe it's time to dip our foot. Would you go buy real estate in San Francisco right now? Would you buy a regional bank? Would you, are there or even credit in some of those types of markets?
Everything is the price. Tell me what the price is, and I'll tell you why we do it. For sure. I'll take commercial real estate. We all know that fewer people are going into offices than used to be the case. So if you go to big office buildings in New York City, you're going to see people there maybe 2 or 3 days a week if you're lucky. Now, obviously, some firms try to get their people back every day, but really 2 or 3 days a week is what you're seeing. At some point, people are going to say we need less space, and at some point, the value of these buildings is going to go down. There's no doubt about it. And so you're going to see some real estate debt is going to be for sale at discounts to what it is today. That's probably the biggest opportunity over the next 2 or 3 years is discounted real estate debt in large commercial office buildings in big cities.
Would you make a bet, though? I mean, this goes to the question about cities and specific cities. San Francisco is a city we talk a lot about on this broadcast. We're talking about Seattle, which has also been challenged. Chicago has been challenged. Are there certain cities you think are sort of too hot to handle?
Occasionally, whenever things go down in the city for a while, people say the death of cities is upon us. But the truth is, large cities are still where people like to come and work, particularly younger people. And I don't think these big cities are going away anytime soon. Clearly, San Francisco's had its, I'd say, public relations problems for sure. But I don't think San Francisco is going away. Prices in real estate are going to go down there for a while. But it's still, a major city in the United States. It's not going away. I don't think people are moving to farms to get out of San Francisco.
Public relations problem because people actually talk about what's happening there. That's public relations.
Well, there's no doubt that there's challenges in San Francisco, but it's not like everybody's moving out of San Francisco to Texas.
No, I know, but there's some serious challenges in a lot of cities, David.
Oh,
it's
sure,
not
but look,
PR. I mean, what if they had better crisis PR people? The problem would go away.
I didn't say that, but I'd say that. And you live in New York City, or you work in the New York City area. So New York City was thought to be dead at the time of the coronavirus. People said this city's not coming back. It now looks reasonably vibrant. There are challenges for sure. Obviously, there are a lot of homeless people here, Washington, D.C., San Francisco. We haven't solved that problem, but I don't think cities are going away.
All righty. Let's get this off here. So let me ask you guys a question. And I saw that IAM put a comment up there. So do y'all think that people are saying this, that the economy is so good, consumers are so strong, businesses are doing well? Excuse me. How much of an impact do y'all think the quantitative easing that happened in March had on this? I think the quantitative easing of roughly $400 billion has a lot to do with what we're seeing right now, but also this, and IAM called this. Remember, you guys, in the last 2 years, consumers have accumulated $250 billion in credit card debt. If the economy is so good and the consumer is doing so well, then how is it possible in any reality, any side of the coin you're on, how is it possible that consumers charged up $250 billion in credit card debt if they're doing well? That means they're not doing well. And then on top of that, you guys, why is the savings rate so low? So if we're doing so well, the consumer's doing well, savings rate is almost historically low. Credit card debt is historically high and increasing at almost, not quite, but almost double the rate of car loans. Okay. What is happening? So here's the misleading thing, the defaults. Okay. So the defaults are basically showing people and telling us that the consumers are fine because they're paying their bills. But again, it's going to take time for the defaults to hit because we're coming out of the massive money printing, okay, low interest rates, massive equity. So people went to their savings or it's still easy to obtain money is the point I'm trying to make. So in other words, you guys, I just think it's a bunch of nonsense. I think, anytime I hear people say the economy is incredibly good right now, well, then why did we have to give the economy $400 billion in bailout? If the economy is good, if the banking sector is good, then why did we have to put that $400 billion back into their pockets? It doesn't make sense to me. I think it's good because they kicked the can down the road again. That's my point, you guys. It's really, and don't get me wrong here. I don't have a fortune. I'm not a fortune teller. It is very, oh my gosh, is my focus? Am I out of focus? It's very hard to call. But I also want to remind you this. The inversion the 2 and the 10 yield inversion, which is a red flag of an incoming recession, has been inverted for almost 1 year now. You guys, the 2 and the 10 and also the 3-month is still massively inverted. If the economy is doing so well, why are those indicators still inverted like that? If the economy is doing so well, we're a debt economy, and only thing that's doing well right now is people getting themselves into debt. And because that's how our economy runs, that's why it appears it's doing well. But who's paying the price, y'all? We're paying the price to make the economy look good, especially new homeowners. These new homeowners that are purchasing right now are pretty much propping up the economy. That I would say, anyways. So, anyways, that's my little thing, you guys. Luke, I saw you, man. I saw you, Luke. I don't know where you are. Is Wolf here? There's Wolf. Wolf, I was just thinking about you, Wolf, because I plan on maybe around September, October. I'm going back out to Copper Canyon. I'm going back out to Desert Oasis, and I'm gonna show these people, Wolf. I'm gonna show these people that those houses are sitting there rotting. So I'm gonna go back there. Wolf knows what's up with those areas. Massive hyper supply and new construction in Wolf's area. But what I want to do now, you guys, because a lot of people are losing hope. Okay, a lot of people are losing hope. So I want to go over. We're gonna revisit the top 5 crashing metro areas, and we're gonna look at median sales price, and we're gonna look at inventory. Now, I want to explain median sales price. We're using median sales price as a gauge for value because Redfin gives us weekly reports and updates. It's very interactive. It has a lot of data. Now, I'm not saying that's the best way to determine value, okay? Just to be clear on that, but it is what we're using. Now, let's go into this part of the video now because I really want to get to how to find a great deal. But right now, we're going to talk about the top 5 metro areas. And then I'm going to show you guys Florida because we're finally starting to see some Florida areas with year-over-year price decline. And then I'm going to show you guys the Northwest coast, because the Northwest coast had a tremendous amount of metro, San Jose, Oakland, San Francisco, that were like crashing hard. But as you guys know, it's the capital of Silicon Valley, which was predominantly where all of that money was injected. So we're going to see if that quantitative easing has a play in things. Let me just set this up like this. Okay. All right. So here's why everyone's freaking out. Okay. Because what we're looking at here, you guys, this is median sales price on a national average level. Okay. So national average. So the reason people are freaking out is even though we're still year over year, so on a national average, as far as median sales price, okay, just to be clear here, we have year over year decline of 1% on a national average. If you have to sell your house, add 8% to that. So the average person, if anyone has to sell, is down actually 9%, not 1% because of the fees it costs. But look at this. Doesn't this look like the blue line is this year, by the way? The black line is 2022. Again, we're looking at median sales price. Look at this. People are saying real estate's going to go to the moon because of this right here. Look, it doesn't even look like it's going to stop. It's just going to keep going up, right? That's wrong. That's so far from the truth. But anyways, this is why people are freaking out. And I also want to make a point. Remember, I'm thinking that it's going to settle down here. Can you all see this? Because when we look at the top 5 metro areas, I want you guys to tell me how close that you think that we're going to end to here. Now, if we end down here, remember, if we end down here, which is 2021 and 2022 median sales price, that means that essentially if you purchased from here on, this is mid 2021 on, you're pretty much stuck in your house. You pretty much did not win. So again, if we end where I think it's going to end right over here, that means you did not win if you purchased from a price standpoint on an overall average. Obviously, there are some people that are great at finding real estate. They find real estate, get a great deal. House hackers on here half the time talking about how great a deal he got. So there are great deals. I'm just talking the average person. So if we end up down here, again, you guys, everyone lost pre-May of 2021 from a price standpoint. Okay, that's all I'm saying. That's what I'm saying. So again, I don't think it's as strong as people are making it out to be. But this is the national average. Again, we're going to look at median sales price. Okay, let me show you guys as well the supply, the months of supply, because we're also going to look at that. So the national average month of supply. Look at how low that is, you guys. That's actually new listings. Let's look at months of supply right here. Okay, okay. So here's our months of supply. We're sitting at 10.2 months on a national average. You guys, that represents slightly. That's about 2.5 months of supply. Okay, 2.5 months of supply is ridiculously low. Okay, we want 6 months, not 2 months. And we started the year out way over here at about 4 months. We started the year so great. Again, quantitative easing. That's what I'm saying. Quantitative easing just straight down. But I just want to make this point, because people are saying, oh, Travis, you're wrong, you're wrong, you're wrong. You guys, we're doing better than we were the last 2 years. Why do people think it's not going to, the prices aren't going to go down again? But we're above where we were in 2022 and 2021. So I just want to make that point. We do have more inventory than we've had for the last 2 years. But I also want to make a point. It's still too low. And what I mean by too low is if the Federal Reserve lowers interest rates right now, we're doomed. House prices are going to go right back up for sure, because we don't have enough inventory right now. So the Federal Reserve needs to continue doing what they're doing, or we're all doomed. And then we'll be like super duper doomed. But let's start with the top 5. Okay, so what I'm going to look at right now, let's start with Phoenix. So we're going to look at Phoenix first. You guys know I flew out to Phoenix. Phoenix, I believe, depending on, oh my God, look at this. Depending on, let me go to median sales price. So this is Phoenix right here. Okay, so we're going to start with median sales price. Now look at this. Okay. So again, I'm just wanted to ask everyone, if Phoenix is doing so well, right? If the housing market is doing so well, if I was wrong about everything, then why is Phoenix down 7% year over year? I'm not talking about weekly. I'm not talking about monthly, because the monthly and the weekly trends right now, actually prices are actually going up. I'm talking about year over year. Year over year, Phoenix is down 7%. So here's the run up in Phoenix. Here's the spring buying season. It went from about 426 to about 453. Okay, but look at it's already starting to plateau. And last year it started to go down the end of June, which is what I'm saying to you guys. Odds are between at least the end of June to the end of August, that's going to be when the majority of metro areas start seeing their prices decline or plateau. We can already potentially see that happening in Phoenix. You can see that. Unfortunately, it's only week over week plateau. So we need more data to show a trend. But look at, again, last year, end of June, then the prices started going down, and they went down so much. Actually, Phoenix ended last year, 2022, down 2%. Okay, so my question for you guys is don't you think when we are on the opposite side of the pendulum, when the seasonal price decline happens, and I believe it's going to be well magnified because of what's happening in the economy, can you guys see this blue line ending over here by the black and orange line? Because I can. And remember, you guys, if that happens, what does that mean? And this is what I'm saying is probably going to happen. What that means is house values are back to mid 2021 levels. So all the people that are like, man, we need price. So in other words, when we do our market analysis, I should be using 2021 data, not 2022 data, because 2021, the second half of 2021, 2022, potentially 2023 are going to have similar prices with essentially what I'm saying is no equity appreciation. But this is Phoenix, you guys. But Phoenix did rebound slightly. Okay, it's still though down 7%. I mean, imagine being stuck there, but I want to show you guys something. Here's something that I've been noticing. Price declines are not like the leading catalyst is not inventory. Look at this. This is insane, you guys. Look at the inventory in Phoenix, okay? The inventory in Phoenix is lower than the national average. The inventory right now in Phoenix is only sitting at 9.5. You guys, do you see that right here? I think you guys can see that on the string. So the inventory in Phoenix at 9.5, the national average is 10.5. Look at this, you guys. Straight down. This is the inventory. This is months of supply we're looking at. Isn't that insane to y'all? So what does this tell us? It should tell us that, again, inventory, for as crazy as this is, it's not the leading catalyst because it's still too low. If the inventory like shot up and exploded, yeah, it would probably be the leading catalyst. But right now, it's not the leading catalyst. From what I'm seeing, traditionally, the leading catalyst is the equity run-up and the unaffordability. And I'll look at a chart from Reventure Consulting to show you guys how expensive Phoenix has got. But look at that. With dirt inventory, literally almost like crap inventory, it is still higher than it was the last 2 years, barely. Phoenix is still down 7%. Isn't that crazy to you guys? So so we don't even have the inventory yet. So what happens if the Federal Reserve actually continues to do what they're doing and we start getting inventory? if we start getting like a good amount of inventory, I'm going to tell you guys right now, it is going to fall apart because we're having price declines right now with no inventory. Y'all tracking with me on this? Isn't this crazy to you? But the number one city, again, Phoenix. Now, I think another factor at Phoenix is the Airbnbs. Airbnbs, there's so many Airbnbs right now in Phoenix. It makes absolutely no sense. I think they got like over 10,000 Airbnbs in the middle of the desert, in the middle of residential neighborhoods. So if Phoenix goes in and like Dallas, Las Vegas, places in New York, and starts re-regulating Airbnbs, dead in the water, because they're going to have a flood of inventory because people can't have Airbnbs anymore. And I honestly don't think that's the right thing. I don't want people to get hurt, but Phoenix is dangerous, you guys. Now let's look at Las Vegas. Okay. So we're going to go to number 2, which is Las Vegas. We're looking at median sales price right here. Now look at Las Vegas as well. Pathetic. You guys, Las Vegas so the run up is right here. So here's Las Vegas spring buying season. So spring buying season went from 393 to about 414. If the housing market, and again, you guys hear all the realtors just like I hear all the realtors, okay? If the housing market is if it's so strong, why is it down 9% year over year? I'm just saying. Let's see here. I wanted to throw these up. I'll throw some comments up in a minute here, you guys. Travis, watch out, look up. Let's go. So here's a realtor, you guys, and realtors here's the thing. When realtors make when they give us attitude, and I'm not saying they are, I don't know, but this just it brings up a point. When they say things like, oh, the sky's falling, but instead median sales is down 9%. If they refuse to talk about this data, they're trash. You guys, realtors are trash if all they do is belittle and cheerlead. If they lack the wisdom and lack the strength to acknowledge decline, they're trash. These people need to quit. Tell me if I'm wrong here, guys. I mean, why can't people at least acknowledge this? I mean, how did I start this? You guys remember how I started this? We looked at national average. We looked at the increase. We listened to a bull. I'm not afraid to talk about the numbers, but this is my gripe with these realtors. And this is why, and again, I want to be careful here because there are some great realtors and there are some great realtors that listen to my channel. I work with some great realtors, but the predominant amount are just children who don't know what they're doing. And I hate to say that, but it is what it is. Again, maybe not the ones that are listening to my channel, not the ones that are using the data, but the ones that are just cheerleading and spewing toxicity, this toxicness. It's like, y'all, we see through you. You're worse than a car salesman. You just want to make your 3% commission. I mean, come on. It's the biggest joke in the book. But look at Las Vegas, you guys. Las Vegas is down 9%. That's irresputable. You can't take that away. 9% decline. 9%. Las Vegas right now. Any Las Vegas realtors, can you explain this to me? Is there any Las Vegas realtors that can explain how is the market doing so well if the year over year is down 9%? They can't explain it because they're too afraid. They don't understand the data, you guys. They understand like how to cheerlead and convince people to buy houses. It is what it is. But I want to show you guys this. Again, if we end down here at 401, if Las Vegas ends over here, again, what that means is everyone that purchased, not everyone, but the average person that purchased mid-2021 and on, you're upside down in your house, or at least you're trapped and you're locked in. And that's what we're seeing right now. That's what the data is showing me. And it's really easier to see this when we look at these higher crashing metro areas. When we looked at the national average, it just went straight up. You guys saw that. But when we look a little bit more in detail individually, you guys can see how these trends could possibly actually end up lower than 2021. Y'all see what I'm saying? So some of these metro areas, Las Vegas being one of them, do y'all see what I'm saying? Once the pendulum swings, you guys, once we go into that seasonal decline, I'm telling you, it's going to be exacerbated. It's going to be magnified, right? So I can see Las Vegas, quite frankly, being under 2021 median sales price. Can y'all see that too? Y'all see that? It's not going straight up. You see this? It kind of balanced the entire year. So I'll be watching Las Vegas, but take a look at this, you guys. This is absolutely crazy. Now, let's look at the months of supply. And this is what I'm saying. The months of supply do not appear to have quite as strong a bearing as we thought. And I also want to make this point. Remember, new home builders hold off of MLS some of their listings. So we don't even have all the listings on MLS from the builders. I don't know if you guys knew that. And some of these builders have like double the inventory than they're showing on MLS. So what numbers are real? But look at the inventory here. This is insane. Just like in many other metro areas, the inventory straight down. Look at that. And crazy. And again, it's so crazy to me. So Las Vegas is sitting at under national average as well, weeks of supply. The weeks of supply are 9.8. So about, again, 2.5 months of supply in Las Vegas. Now, again, this time last year, look at it shot up. So again, last year it shot up. So other side of the pendulum. But that's Las Vegas, you guys. Very, very intriguing. Let's go over Boise. Boise is also crazy. I mean, these things are absolutely insane. What's going on right now, obviously. Let's take a look at Boise. Okay, here's Boise. Let's go to first median sales price right here. Okay, take a look at Boise. Y'all, okay, again, y'all, like these people, these realtors, man, you guys see how scummy they are? Again, not the good ones, and that's why I keep preaching for as many as the realtors I'm saying are bad. I'm also saying that there are realtors that are good. You guys, when you find a realtor that is truly valuable, you need to hold on to them for like your entire life. I'm not joking because it is rare, but there are some realtors, you guys, that are composed, they're well spoken, they use the data, and they actually care about you. Can you believe that? I mean, we can't tell from YouTube, but there are some good people actually on YouTube, to be honest with you, just not many. But look at this, guys. Here's Boise. Okay, so if there's any realtors from Boise, why is Boise down 13% year over year? If it's doing so well, why is that? So again, guys, Boise's down 13%, really shocking. It started the year at an average median sales price of, median sales price of $463,000. It's now at $471,000 during spring home buying season. So this is all, I mean, it basically did nothing. It went up slightly during the spring home buying season, but look at how close it is, Boise is, to being under 2021 levels. So Boise's almost already there. Boise's already almost there, you guys, under 2021. So, I mean, what do you call that? Okay, let's see here. So let's see. So here's another comment, you guys. I mean, I don't know what's with, I don't know, Mr. Watson, let us know if you're a realtor. All right, let us know if you're a realtor. Half the time, I don't know if, why people are saying what they're saying, but let's read this. Has predicted 20 of the last 0 crashing markets. I don't know what this guy's saying. At what point do we just agree we don't know what the future holds and just make sure to save and buy a house that makes sense for you? So I don't, I think Mr. Watson is confused right here. No one knows what's going to happen, Mr. Watson. And here's the point I'd like to make with Mr. Watson. So, Mr. Watson, you don't know what's going to happen. And right now we have a tremendous amount of dust in the air. We have quantitative tightening happening, and we have sneaky quantitative easing going on because the economy is falling apart. And the thing is, Mr. Watson, is I believe in caution with other people's money. I believe when people buy the biggest investment of their life, that they should be careful and not so optimistic. And the reason I believe that is foreclosure, repossession of car, all bankruptcy, all these types of things is a horrible thing to go through. And I'm not personally willing to potentially help people go through that. And that's my thing, Mr. Watson. But do me a favor, my brother, stay for the end of this, and I'm going to show you how to find a great deal. Because the reality is, if you can find a great deal, and I'm looking every single day, Mr. Watson and these haters, you guys, they really are full of assumptions and assume they understand what I'm saying, when the entire time I've been saying, if you can find a great deal, get it. But what is a great deal? That's the thing that we have to understand. And we'll get to that last segment of this, you guys, to talk about what a great deal is. But the reality is, this is the other thing that I'm worried about. What a great deal today is may not be a great deal 2 years from now, right? Because like Mr. Watson said, we don't know what's going to happen. So it could be very well that we go into a depression and not a recession. But you guys, it is so crazy. It's just how the industry is. I mean, people are just so hypersensitive. It's just how it is. It's really crazy. But anyways, look at this, you guys. Median sales price in Boise. I'm showing people this negative 13%, and still people are like, just accept it's not crashing. It's just like, dude, just accept you don't get it. Just accept that you're probably on some like dopamine, or I don't know. You're on some type of high, and it's probably rage because you bought. I don't know. But regardless, hello, knocking on the door here. Boise's down 13% year over year. right here. And that's with, you guys, look at this. Look at the inventory. Okay, so Boise down 13% year over year. Pretty much anyone, even a child, maybe not Mr. Watson, but even a child can see more than likely we're going to end Boise. Again, no one knows this for sure. We're going to end Boise under 2021 and 2022. I'm calling it right now. You guys can see we're already almost there. We're literally already almost there in Boise. But look at this again. When do we get our inventory back? Take a look at the months of supply. This is insane. The months of supply in Boise, unbelievable. Under 2022 now at 8.5 weeks of supply. So Boise has less inventory than the national average, and yet the price crashing. I wonder if fundamentals matter. Do you guys think that fundamentals are matter? You know, is that why we're saying this? Because of the equity buildup was a lack of fundamentals. It was built on a house of cards. Do you guys think that may be why? That we don't necessarily need the inventory to see these price cuts? I think that's possible. But again, look at what we started at. We started really, really high in inventory, and it just got zapped, you guys. Absolutely zapped. Now, inventory in Boise started shooting up in June. You can see that. So really, any changes could happen here, and inventory could start shooting up, right? And we see that. So that's what's going on with Boise. Now, let's look at Austin, you guys. Austin. So first of all, Boise is at what, 13%? Now let's go to Austin. I'm going to go to median sales price for Austin. Okay. All right, here's the median sales price for Austin. Again, you know, like these realtors are wackos. I mean, these people are almost useless, you guys. These people that are hating are useless. I mean, it is what it is. They like hearing themselves talk. They want to be so right that they feel like if they're just emotional enough, they're going to be able to change reality. Like their emotion, if they just feel, they're going to feel it, right? They're going to feel it into existence. I mean, it's a complete joke. I mean, these people are absolute clowns, you guys. It is what it is, but not all of them, you guys. Again, I hope you guys know when you're talking to realtors what to look for now. I mean, you can say anyone that's hypersensitive, you know, tell them to kick rocks. But look at Austin. Look at Austin. Austin is under 2021 median sales price. I mean, I'm showing these people, you guys, I'm trying to show everyone, I'm sounding the alarm still, right? The seasonality, the quantitative easing. I'm trying to explain with data. I'm linking it and everything. I'm showing you Austin is under 2021. If the housing market's so strong, why is Austin's median sales price under 2021? Why? Because it's not strong is the answer, because it wasn't built on fundamentals. Okay, it was built on COVID. Let's just say COVID. But look at this, guys. Austin's down 11%. And again, it's under 2021. So don't you think, again, going into the fall, going into the winter, don't you think that in Austin, we're going to end the year under 2021 as well? Do y'all think that? And if it does, in Austin, if it does, they go all the way back to March of 2021. So in Austin, if you purchase after March of 2021, odds are your value is going to be the same 3 years later, which means what? It means you're trapped in your house. Now, is that a big deal if you plan on being there for 10 to 15 years? It could be a big deal if you get fired, medical emergency, divorce, things that you don't prepare for. But if you can ride out owning a home for 10 years, yeah, odds are it may be able to rebound. You may be safe, right? So that's the decision y'all have to make. I've decided I'm not doing it. I would rather just rent right now. It is what it is, at least I'm being honest. But look at you guys. Austin down really massively. 11%. I know, Mr. Watson, that's not your money. It's probably your client's money, so you don't care about it, just like most realtors. But massive, you guys. Huge. So again, we got to look at the big picture here, okay? And again, we started looking at national average. It was like, looked like it was going straight up. But look at when we look closer. Now let's look at the next one, which is going to be, okay. So number 5, I had to decide what to do, and I'm going to hurry up, you guys. I know this is going long. I'm sorry. I had to start talking about realtors. It really sets me off. I really look at most realtors as bullies and frauds. Most realtors, bullies and frauds, and then the good ones, golden assets. Isn't it? It's a huge contrast. It's like there's nothing in between. It's either like scumbags and frauds or absolute stud golden assets. It's the craziest thing ever. We should have like no frauds and clowns, but they're everywhere, as you guys can see. But look at this, you guys. This is San Diego. Now, I had to decide, like, do I look at San Diego or do I look at Salt Lake City? I'm choosing San Diego because San Diego is just insanely unaffordable. Insanely unaffordable. But you guys can see here that San Diego is only down 3% again, year over year. So San Diego down 3% year over year. So again, what we're thinking, what I'm hoping is it's going to end up over here again when we end the year. You guys can see that the decline started happening the end of June last year. Y'all see? Which is what I'm hoping is going to happen again this year. But you can see that here as well. In San Diego, again, hit to June, boom, starts going down. Hoping that's going to happen. Now look at the inventory, y'all. The inventory, just imagine inventory. Imagine what would happen if we had double the inventory. Look at the inventory. This is San Diego is in a crazy situation, y'all, because it's so unaffordable. House prices went up so much, but there just ain't no inventory. When I went there and did my boots on the ground, I found new home building. But the new home building that I found, you guys, were like cardboard boxes that cost $500,000. Actually, I'm sorry, they cost $1 million for a cardboard box. So I found plenty of new home building in San Diego, but my God, look at San Diego, you guys. I mean, it is so low. Insane. All right, so that's those 5 metro areas. Now what I want to do, so basically what I try to show you is these metro areas, you guys, are probably going to have that median sales price back at 2021 levels. All right, you heard that here first. All right, I'm trying to be bold. I'm trying to explain why I think the way I do. So watch it. That's San Diego. But let me show you this now, okay? And then, really pay attention to what I'm trying to say here. Now, what I'm going to do, I'm going to look at Florida. We'll look at the East Coast as well. I'm running so far behind. I'm so sorry. I may just do another video tomorrow showing you guys how to find a great deal because I'm running out of time here. But I want to make this point. Some of the leading metro areas that experienced price decline were Northern California. Do y'all remember that? It was like Oakland, remember? San Jose, San Francisco, Sacramento, right? Those were the metro areas that were actually leading the price crash. San Jose was actually down 22%. But the thing is this, remember, it's the capital of Silicon Valley. And when they did the bank bailout and they injected all the quantitative easing to those banks, those regional banks in Silicon Valley and all of the businesses in Silicon Valley, look at what happened to the properties, you guys. This is what I'm trying to show you guys. I want you guys to see in the Silicon Valley basically what happened. Mr. Watson, I see you. You're not a realtor. You just act like one. I'm sorry, man. I get confused sometimes. I never know people's intent. I wish I did, man. I mean, it's just, I don't know. Like, are they hating for this reason? Are they hating for what's their motivation here? Because we're showing them the data, they just don't want to accept it. I don't know. But Mr. Watson, I'm glad you're not a realtor because you would be murdering clients right now. You probably should not be one. And that's no offense. That's tough love right there. So let's go out to other places, you guys, in Northern California. Look at San Jose. You can't tell me that the quantitative easing didn't impact San Jose. Look at this. San Jose started out the year, look at this, down as much as 17%. Look at that. 17% down year over year in San Jose. Again, that was as of what, March 12th? And then the quantitative tightening hit those banks. And look at this run up. This is insane. Massive run up. It's still down. It is up 2% year over year. It is massively down from peak, though. You guys can see it's down about what, $100,000 from peak, about 6% roughly. But San Jose, you can't look at this data, you guys, and say San Jose is going to end up down here. Y'all see what I'm saying? You can't tell from the data from San Jose. Yet we could tell last year. Look at what happened last year. Right before June, it started going down. But that's not happening. Do you guys think that has to do with the quantitative easing? I think it might. Now look at Oakland. This is insane too. Same thing with Oakland, guys. So Oakland actually started out the year down 10%, and it was actually down 2021 as well. So Oakland was under 2021 levels. The housing market's fine. Just buy a house, right? Who cares if you lose hundreds of thousands of dollars in equity? I know some people do, though. I care myself. But look at this. Massive run up. We can kind of see maybe it's going to plateau, but we see basically last year around this time is when Oakland started going down. So right now the trajectory is not showing that. We have a week over week balance. But again, those northern cities that were showing massive decline, it's still showing massive decline of 6%, but it's not showing 20% like it was, right? That's my point here. Sacramento, look at Sacramento. See, same thing with Sacramento. All of the places around that Silicon Valley, the regional banking disaster that was bailed out, are flourishing right now from a standpoint of median sales price, not inventory. Look at this. Same thing here, guys. This is so crazy, Sacramento. So I guess it's fair to say, all right, this is basically what I want to say. I guess it's fair to say that if the Federal Reserve decides to continue to do quantitative easing and continue to inject money into our economy, odds are we're going to be in the same situation we're in now, if not worse, because we can see from those northern cities how important it is to not continue to inject liquidity into the economy. And that's really why I believe that we're seeing these trends this way, y'all, is because of that liquidity. Because if we really think about what would have happened if they didn't bail out all those banks, come on, you guys, it would be in the news still right now. That's all that everyone would be talking about. Where's the next bank failure coming, right? You can't change my mind on that. I mean, that's just how it works. So anyways, let me show you guys one other thing, because again, leading factors here, when we take out quantitative tightening, you guys, when we take out the quantitative tightening, is the run up in equity and the unaffordability. So this is a revenge trap right here. And I want to show you guys some of those places that we looked at in the unaffordability, starting with, where's my San Diego? So San Diego. And this is why I was talking about San Diego. San Diego right now, it's at 71% of median household income going to paying off your mortgage. And that's why San Diego was on my top 5 and on other people's top 5, even though they have like no inventory, but they are year over year price decline. But the unaffordability, 71%. Look it up here as well, Boise. Boise is at 48.83%. So again, we see a lot of decline here on the West Coast, but that's also the most unaffordable areas. I'm sorry for that arrow thing, you guys. I hate when it glitches like that. But look at this, would account for why we saw so much decline on the West Coast, but on the East Coast and in this area here, we didn't see as much decline because technically it's more affordable. And again, Boise, super high. Las Vegas, what was Las Vegas at? 44%. What else we got here? Flagstaff's on there. Phoenix is on there at 43%. Austin is at, where's Austin? Is at 48%. Now, I think Florida, here's the situation with Florida, okay? I think Florida's already starting to soften. And we can actually look at that. If I had more time, you guys, I think I'm going to look at Florida. Actually, no, I got to go into how to find a great deal. But I wanted to show you guys Florida because there are some metro areas in Florida that are softening from a price standpoint. And look at how unaffordable it is. All right. So let me just show you that actually real quick. So let's go and let's say Tampa, Florida. I'm doing this because we know how resilient Florida was. Okay. Median sales price in Tampa. Look at finally, right? So Tampa, Florida down 5% year over year. Finally, right? People are like, Florida is not going to crash. Florida's okay. But look at Florida is finally starting to soften. And I'm saying predominantly the reason that is the unaffordability and the massive equity run up. And the reason that it took so long for Florida to soften is the massive migration and speculation that's happening in Florida. Florida's the number 1 state of migration. And I would argue speculation as well. And I think that's why we see that. But look at Tampa right here is down finally 5% year over year. All right. The magnificent Florida. Let's look at Orlando. Orlando is barely up right now. Orlando's only 1% growth. Okay. And look at, so Orlando's pretty much going sideways. I'm hoping, like I said, it's going to end down here, but that's Orlando. At least we're not seeing like crazy increases. Let's look at Cape Coral, not Cape Coral. Okay, look at Cape Coral, down 3% year over year. So again, we're seeing Florida metro areas now on the year over year decline list. But yet the housing market's so great, right? The housing market's so great. And I'm not trying to pick on people that are buying right now, y'all. I hope you guys understand that. I'm really not trying to pick on people. What I'm really trying to do here is say, be cautious and don't listen to cheerleaders, right? Be cautious, do your own work, follow the data, find something that works for you. And the thing is this, you guys, for my primary residence, I'm not talking about investing, for my primary residence, I'll overpay slightly for something that I love. absolutely love. There's no way that I'm going to overpay for something that I'm settling on. So also I'm saying you probably shouldn't settle, right? And use the data, not your emotion. And I'm going to tell you guys, if you go into purchasing, buying a house with your emotions, you're going to get wrapped right up in the emotional challenges that almost every home buyer goes through. And that's my gripe again with the realtors, is like they feed on the emotion, but not the good ones, not the good ones, not the great realtors. Okay. But anyways, now let's go over how to find a great deal. Okay. So let me remind you guys, I'm going to do it like this. This is what we're going to be filling out right here. Okay. This is very easy. I'm going to see how fast it's going to take me to do this. Okay. But that's what we're going to be filling out. It's very, very easy, you guys. It's not a lot. Let me show you guys just one more time. Okay. We're going to fill this out and we're going to find and see if we can find a great deal, in other words. Okay. Now I'm going to do this. I'm super nervous about this. I'm going to do this in the fastest amount of time possible. And the reason I'm going to do that, you guys, is I really want to dig home because I want realtors, because I talk to realtors a lot, and I want realtors to know that I'm not picking on them unless they're the bad ones and they're bullying people. Then yes, I'm picking on you if you're a bully. But I'm not picking on you guys as realtors. What I'm saying is like, please, you guys, stop the cheerleading. Please stop the cheerleading. Start using the data. Talk about the data. Show people how to be safe, right? That's what I'm telling realtors. So I want to show you guys that you can do that if you're a realtor, or the most important person, what my channel is designed for, is the consumer. I want you as consumers, if you're going to interview a realtor, you can take them to this video. It will be timestamped and say, I want that. I want that market analysis for price per square foot. I want that market analysis on rent. Okay. And then when you have the data, you can figure out how to invest. So if I offended any realtors and you are good realtors, I'm sorry. I did not mean to. That goes also to Moses. Moses, I love you, brother. I was not picking on you. I'm sorry if you took it that way. I'm just saying, man, we got to be super careful because this is a lot of money that like consumers are spending, you know, and these people are family people. So that's my point. Now, what we're going to do is someone gave me a subdivision, okay, called Sienna Plantation. At the top of the comments, you guys can go back if you want. But I had I think it was Ima. I think it was Ima that sent it to me, or Kim. But Sienna Plantation. Listen to me very carefully. Value is generally not calculated by median sales price. Value is generally calculated by sold properties in a subject property subdivision by comparing characteristics and assigning a dollar value to those characteristics. In other words, an appraiser will use generally three sold properties in a subdivision. They will compare the three sold properties to the subject properties, and they will make price adjustments based on those characteristics. Okay. So I just want to let everyone know that I understand that. But we're using median sales price. Now, we're going to do an exercise today based on basically in this right here, you guys. Okay, we're going to figure out what the price per square foot. Before I start the timer, okay, I'm going to explain all this. Before I start the timer, we're going to get the price per square foot for 2022 and 2021. And we're going to get the rent per square foot for 2022 and 2021. And then we're going to find a property and we're going to calculate the payment. Okay, we're going to do all that in this podcast. But one thing first, because I get this question a lot. How do you find a good realtor? Well, the first thing is you're probably going to want to pray a little bit because it is hard, you guys. But again, there are good realtors. But let me show you how to find a good realtor, okay? You simply, okay, you guys, the cat's out of the bag. I was trying to make this a little bit more suspenseful. All right, so we're going to find a great realtor. All right, this is what you guys got to do. And I bookmarked this, okay? I'm going to exercise my right as a consumer, and I'm going to go to Google. I don't know if you guys know what Google is, but I'm going to go to Google. I'm going to put top realtors in, what city is that in? What city is that in? Shoot. Sierra Plantation. I don't know what city that's in, darn it. But let's just say in Kingwood, because we've been looking at Kingwood, okay? Top realtors in Kingwood. Look at guys. Look how hard this is. Oh my gosh. I don't want to hear anyone. Look, you know, where do you find the good realtors? Look at. I typed in top realtors in Kingwood, and look at this. So what I'm going to do is I'm going to have a list of things, and I'm going to call these people up, and I'm going to say, hey, I'm shopping realtors. This is and I'm going to be honest. I'm not going to trick them. I'm not going to lie. I'm going to be very forthcoming. I'm going to be very honest with them. I'm going to say I'm shopping realtors. This is a very big deal to me. It's the biggest financial transaction of my life, and I want to make sure that my realtor is the best possible realtor. So you go through here, guys, and look at all of these. There's so many realtors, and the crazy thing about this is look, they all have ratings. They all have ratings. Look at this guy has 115 ratings, all 5-star, right? 26 ratings, all 5-star. 57 all 5-star. 67 all 5-star. Look at this lady has 314 ratings. Look at this, guys. This lady has 1,400. So if it's me, I'm starting here because it's the first one that comes up, and there's 1,400 ratings out of 4.9 stars. But you guys see, we shouldn't be making excuses about realtors. It's that easy. You guys got to put in a little bit of work, call them on the list, and then based on what you're hearing, decide who you want to work with. Do y'all see what I'm saying? But we're gonna get started. So we found our realtor, and now we can do this. Okay, so I'm gonna set this up. I'm scared. I'm gonna do it like this. Go like this. Okay. Okay, and remember, I'm gonna be flashing to here. Okay, I'm gonna be like this, and I'm gonna be flashing to here, like this, and we're gonna fill this out. Okay, so we're gonna be filling this out. Okay, guys. Jeez Louise, what's up with my camera angles right now? Okay, we'll just go like this. All right, so I'll be like switching to this. Okay, so I'm not ready yet. I need the timer to start. Okay, so I'm gonna show you guys how to find a great deal. What time is it right now? It's 9:46. So I'm going right now. Okay, we're gonna find a great deal. Now I'm on my active MLS right now. Remember, it's hyper local. We're talking about subdivision. Someone gave me Sienna Plantation subdivision. The first thing I need to do is I need to collect data to figure out what homes are selling for in 2022 and in 2021. So I'm gonna change my date to see all sold properties in that date range as well. On Travis, keep it together. Keep it together. Dang it. As soon as that clock started, normally I'm like way better at this. I think I'm doing this the wrong format. Oh my God. I can't believe I just did this. Psych. It's not. It is. Is this the wrong? Oh my gosh. Okay. Let me try this again. I have to do it like this, you guys. I'm so sorry. Slash. It's not a dash. I put the dashes instead of slashes. I'm a slash guy, not a dash guy. It doesn't matter. All right. We have it in for 2021. I'm going to go to results right here. I'm doing this as fast as possible. I'm going to select all of the comparable data because this is how value is generally determined by sold properties. I'm going to go to stats. I'm going to go to tabular, and I'm going to get my first reading for that subdivision, right? Okay, so let me switch to this right here. So we're going to do price per square foot. We have right here, $169, okay, and 47 cents. So I'm going to put 169.47. Okay, you guys see that? So we got that first one right there. Okay, let's go back here. Oh my God, I'm losing time. Oh my God. Okay, so I'm going to do the same thing. Oh, I got to put this in here again. What was the subdivision? Give me the subdivision again. Let's go back here. Let me copy this real quick so I could just copy and paste this. Y'all, and I'm making mistakes and I'm timing myself. So, just put that in perspective right there. Okay, so then I'm going to go back to sold properties. We're now going to look at 2021. Look at how fast I'm going. And I'm making like mistakes because I'm nervous. Okay, we're going to put this date range in here from January to December of 2021 now. Okay, we're going to get all sold properties. We've got 138 sold properties in Sienna Plantation. So we're going to look at the results here. Okay, we're going to select all of this. We're going to go to stats. We're going to go to tabular. Okay, so now I have $147.88. Okay, so I have $148.88. Oh my God, you guys. Okay, so you guys didn't see that. Okay, oh my God. Okay, so look at you guys. Here's the 2021. You guys can see that right here. I have $147.88. Sorry, I did not show you guys that because I was still doing something else. And let's go like this. So I'm going to put for 2021, I'm going to put the 147.88. Okay, see that? And what's my time, y'all? What's my time? So we got 2 years of data on price, and it's 9:49. That means 3 minutes so far. So now I'm going to go over to the quick rental analysis. Why am I looking at rent? So just in case we have to rent our property out, so here's the rent right here. If we have to rent our property out, we need to make sure we cash flow, okay? So I'm only gonna look at Sierra Plantation, and I'm gonna look, again, only rented out properties for January to December of 2022. Okay, so let me pull that in right here. I see you, Johnny. I can't let you troll me though, Johnny. I'm already behind on this. Okay, so this is 2021. So I'm first looking at 2021. Let's look at results. Selecting all comps, looking at stats and tabular data. So for 2021, okay, average price per square foot for 2021 is $120. Okay, let's go like this. Okay, so that was $120. Okay. All right. See how easy this is? What's my time, you guys? I'm almost done with the rental analysis as well. We're going to go to sold now, and we're going to look at 2022. You guys see how easy this is? 2022. When you're not using slashes and dashes, it's easy. The hardest thing about doing this is the slashes and dashes. Okay, we got our date range in there. Let's make sure our subdivision is the correct subdivision. Sienna Plantation. Let's look at our results. We got our results. We're going to select all. We're going to go to stats and tabular. And let's see what we have. So we have the same. Okay, so we have the data at least. Let's go back here. See what we're doing? We have the data. That's it. So I just wanted to say, you guys, in 5 minutes, I now have 2 years of data on the subdivision. I know what the average price per square foot was in 2021 and 2022. And I know that homes are renting out for $1.20 a square foot. Okay. Follow me so far, y'all? Pretty easy, wouldn't you say? Okay. But look at this. Now that I have the data, what do I do? Okay. I'm going to go back here. Let's go to search. We're going to go to quick search right here. We're going to go to active listings. So this is active, and I'm going to put in the subdivision, Sienna Plantation. Okay. 21 available houses. Let's look at the results. Okay. Now remember, I'm going to categorize now. Can you guys see that? Okay. By price per square foot. And look at, now that I've categorized the listings in that subdivision by price per square foot, what do we know? All right, let me go back here. Let me show you. Remember, $147 a square foot in 2021, $169 you guys can see in 2022. Let's see if we have any homes at 2021. Okay, so do we have any homes at 2021 price per square foot? No. Do you see that? Because remember, it's $147. That's what we're looking for. We don't have any homes listed at $147. Y'all see that? So we have no homes in the subdivision listed at 2021 values. Now, let's see if we can find $169 a square foot, which would represent 2022 values. And you guys can see that there are several properties that are under 2022 averages. We have 1, 2, 3, 4, 5 properties. So these first 5 properties are listed for under 2022 values. Y'all see what I'm saying? Okay. So I know immediately which houses that I should be looking at. So let's just start with this first one now that we have the data. We're going to click on this, okay? Let's actually click on the listing, and then we're going to find out what a payment is, okay, guys? So now we're going to move on to the payment. I want you to follow along with me, okay? We're going to go over the payment, and what I need for the payment is I need the listing price, but I also need my square footage, you guys, because I need to know what I can rent my house out for. So I need purchase price, I need square footage, and I need property taxes, okay? Property taxes are generally at the bottom here. Where's my property taxes? Okay, why aren't they listing my property taxes here? Interesting. Okay, so it's probably, no, it should have property taxes. So there's no property taxes on this page, but let's say there was. Okay, so normally when it's a consumer view, the property taxes, just for the sake of time here, for this property, you guys, is going to be $9,000. Okay, so let me go back here. I'm going to put the property taxes are $9,000 a year, so I can calculate my payment. Remember, I'm making that up because it wasn't on that screen, but I need my property taxes, and also I need my square footage. And remember, the property square footage was 3,000. 463 square feet. I need that to figure out if I can cash flow, but also I need my purchase price. My purchase price was $467,000. Okay. Now let me go back here. And remember, this is selling for $152 a square foot. So you can argue, just depending on how you look at it, I still think we need to be at more under 2021 values. But if you want under 2022 values, you can see that this property is the highest under 2022, okay? So now we got to figure out our payment. So say we want this house, we got to figure out our payment, and we got to figure out if we can cash flow. The way I do that is, again, I go to Google and I put in mortgage calculator. My time. So in 9 minutes, I have a complete 2-year breakdown of that subdivision in 9 minutes. I just wanted to let you guys know that. So we're going to go to the payment calculator. We're going to check include taxes and insurance. Now, the first thing I'm going to do is I'm going to set up my property taxes down here. Remember what it was, you guys? Let's go back and take a look. Property taxes were, you guys see, $9,000, and purchase price was $467. So let's go back and let's put that stuff in. Okay, so $9,000 for property taxes. Okay. And let's see here. And the purchase price was $467,000. You guys tracking with me? Boom. Look at this. Now I have pretty much almost everything set up. You guys see how easy this is? Now, here's the thing. Okay, so we're starting at a 20% down payment, interest rate at 7.5%. Now, having a 20% down payment means I don't have mortgage insurance. But let me show you guys this. Let me make sure this calculator comes up. Yes. Okay. Now I have to make sure that I can cash flow if I ever have to rent the house out. So I need to see what homes are renting for, which is right here. See that? Because what did we do? We did a rental analysis. So I know homes can be rented out for $1.20 a square foot. So I go back to here. I know that the property is, remember, 3,000. What was it again? 3,063. Okay. That's the square footage of the subject property. Let's multiply that by the rent of $1.20. That's what I can get potentially in rent. Do y'all see that? So potentially in rent, I can get $3,600, but my mortgage payment's $3,500 at 20% down. What does this mean, Johnny? Johnny, what does this mean? This means that technically I could barely cash flow on this property because I can get more rent. You see that? Than I can get than my mortgage payment. But still, you guys, that's super tight. I still wouldn't do it. But that is how you basically find a great deal. You just keep going through scenarios like that. This is one of the simplest ways to do that with looking at price per square foot and rent cost per square foot. Okay. So I'm done with that. And I did that in 11 minutes. So in 11 minutes, I did that. I hope you guys liked it. That's what a realtor could do for you. That's what you could do if you decide to get your realtor license. And I just want to make this point, you guys, I'm not trying to offend you, okay? Unless you're a bully. If you're a bully, yes, I am trying to offend you. You guys should kick rocks if you're a bully, if you're crazy, if you're a psycho, whatever. But I want to apologize, okay, if I've offended you. I'm not trying to. I'm trying to basically have people understand how important this is, how we got to just not use our emotions, not just call people names, just look at the data and let's try to figure out what's going on. I'm not trying to time the market, okay? I'm not trying to time the market. I don't have a crystal ball. I'm just a normal person. But the thing with me, guys, is at least what you have with me is I'm putting my money where my mouth is and I'm renting myself. I don't like it. I'm doing it myself. But anyways, guys, I really appreciate you. I'm going to get out of here. Boom, boom, boom. Don't forget to like the video, you guys. AE, I see you, AE. Appreciate you, AE. Appreciate you. Nikki, appreciate all you guys. All right. Other than that, I appreciate y'all and happy Monday. And look out for this evening's video. It's probably going to be on evictions. And happy Monday, you guys. See you guys later. And